I've backtested this scalping strategy thousands of times, and every single month the results stayed consistent. No indicators, no fancy setups, just pure, clean price action. By the end of this video, you'll know exactly how to trade it, step by step, and how to catch moves like this one before the crowd even realizes what's happening. In this video, you'll learn step by step how to trade the most powerful scalping strategy, even if you're a complete beginner. You'll understand market structure, you'll learn how to spot support and resistance levels the right way, you'll master the BRR pattern, a 3-step setup for high probability trades, you'll see how to use top-down analysis to align your trades with the main trend, and finally, we'll look at real chart examples so you can apply everything you learn with confidence. This scalping strategy works on the 1-minute and 5-minute chart. This strategy works on all markets: crypto, forex, stock, commodities, options, and futures. Now, let me show you a real setup. Simple, clean, and easy to understand. The market makes a breakout, followed by a pullback, which forms the retest, and then a clear rejection candle confirms the move. This is the BRR pattern: breakout, retest, and rejection. A setup that appears again and again in every market, every day. All you need to do is place your entry, set your stop loss, choose your target, and watch the market move in your favor. But here's the truth most traders miss. You can have the best looking setup in the world, perfect entry, tight stop loss, everything in place. Yet, if you misread the market structure, that perfect setup can collapse in seconds. That's why before anything else, we start with the foundation: market structure. To trade the BRR pattern effectively, you first need to understand market structure, the foundation of every trading decision. The market only moves in 3 ways: uptrend, downtrend, or range-bound. Recognizing which phase you're in changes everything. It's the difference between trading with smart money or against it. Let's start with the basics. In an uptrend, the market creates higher highs and higher lows. Each higher high shows that buyers are still in control, pushing price to new levels. Each higher low tells us that when sellers step in, they fail to take price lower, showing strong demand in the market. Inside every uptrend, there are 2 types of moves: the impulsive move, which is strong and fast. That's when smart money is actively pushing the market in their direction. The retracement move, which is slower and corrective. That's where most retail traders get trapped, thinking it's a reversal. In an uptrend, buyers buy low and sell high. They use retracements as opportunities to enter, not as signs of weakness. Every time price pulls back, institutions accumulate more positions before the next impulsive leg. In a downtrend, the market creates lower lows and lower highs. Every lower low shows that sellers are in control, breaking new ground. Every lower high reveals that when buyers try to push back, they can't even reach the previous high, showing weakness in demand. Again, we have impulsive and retracement phases. Impulsive moves happen when smart money dumps large positions, creating sharp sell-offs. Retracement moves are small pullbacks, the illusion of recovery, where retail traders often try to buy the dip too early. In a downtrend, sellers sell high, buy back low. Institutions use retracements to add to short positions, while most traders get trapped, buying into falling markets. And finally, we have the range-bound market. This is when price creates equal highs and equal lows, moving sideways with no clear direction. It's a phase of equilibrium between buyers and sellers. For beginners, this is the most confusing phase, because the market looks unpredictable. But in reality, ranges are where smart money prepares their next big move. They accumulate positions below support and distribute above resistance, creating liquidity traps to hunt stop losses before the real breakout. Ranges exist because both sides, buyers and sellers, are waiting for confirmation. The longer the range holds, the bigger the breakout that follows. So before you take any trade, ask yourself, am I trading in an uptrend, a downtrend, or a range? Because identifying this correctly decides whether your BRR setup succeeds or fails. Now let's move to the second component of market structure: support and resistance. So what exactly are support and resistance levels? They're price zones where the market has previously reacted, either rejecting the area or reversing direction. We draw them on the chart because when price returns to these areas, they often become decision points, places where liquidity builds, traps are formed, and smart money steps in. Support and resistance are not just lines, they're zones where the market reveals who's really in control. For a support or resistance level to be valid, you need to check a few key criteria. These filters separate random lows from zones that truly matter to smart money. Major swing highs and lows. Start with the most recent extremes, the clear turning points where control flipped. These highs and lows are natural reaction zones the market remembers. Multiple price rejection.